Here's a fact that stopped us. Two industries that have almost nothing to do with each other, memory chips and electricity, are both sold out years in advance. That doesn't happen by accident. I'm Onyx.
And I'm Nova. This is the Working Thesis. Today, the big one, a full walk through our largest thesis, the AI value chain, all 4 layers, and the one idea that organizes everything. Value tends to flow to whoever sells the scarce input, not to whoever spends the most. Quick note: the Working Thesis is personal market commentary for education and entertainment only, not investment advice and not a recommendation.
We mention companies as examples of a theme, never as buy or sell calls. Do your own research and make your own decisions.
Start with the why. AI is the one productivity story large enough to matter against an aging workforce and heavy debt. Goldman's economists even lifted their long-run U.S. growth estimate on the back of it. That's the bet. AI is the productivity escape.
But AI is big, isn't investable on its own. The useful question is narrower. Inside the chain, who actually gets paid? Our answer, the through line for the whole hour, is own the inputs, not the spenders.
So here's how we'll spend the time. Build the map, ask whether the demand is real, find where the money lands, and then walk all 4 layers name by name. Let's go.
We treat AI as a 4-layer value chain. Layer 1, silicon and compute, the chips themselves. Layer 2, infrastructure, the clouds and hyperscalers that deliver it and write the giant checks. Layer 3, power and materials, the electricity, the turbines, the metals. Layer 4, physical AI, robots, still a watch layer.
Notice the logic of the stack. Each layer sits on the one below it. No clouds without chips, no chips running without power, no robots without all 3. The deeper and scarcer the layer, the more pricing power it tends to have.
The big worry is that AI demand is peaking. Our read is the opposite. Hyperscaler capital spending is climbing toward roughly $700 to $785 billion this year, on a path toward $1 trillion by 2027, and the guidance keeps going up, not down.
The token usage peaked. Headlines are about efficiency and a shift to cheaper, open and local models, not aggregate demand falling. The cleanest tell is cross-confirmation. GPUs, memory, and power all in multi-year shortage at once. When 3 unrelated supply chains are all booked solid, that's demand you can measure.
And notice where the money now goes. Power and cooling are most of the spending increase. The bottleneck moved from chips to electricity. That single fact reshapes the whole thesis, and it's why Layer 3 matters more than it did a year ago.
Here's the pattern that names the thesis. Map the chain by share price and a gradient appears. The closer a company sits to supplying the scarce input, memory, the chip-making tools, the optics, the power, the stronger it's been.
And the further it sits toward spending the capex, the hyperscalers writing the checks, the more the market has doubted it. Same demand, opposite tape, depending on which end of the chain you're on.
Own the inputs, not the spenders isn't a slogan, then, it's a description of where the cash is flowing right now. The whole rest of the episode is just walking that gradient layer by layer.
Be honest about the risk. It isn't that demand stops, it's whether the spending earns its cost of capital. Fast chip depreciation, and the chance that after a huge build-out customers pause to digest the capacity, leaving an air pocket in orders even with the secular story intact.
And one valuation rule will carry through every single layer. A low forward price-to-earnings ratio does not mean cheap, especially for cyclicals. Memory is the textbook trap. A name can show a high trailing multiple and a low forward one at the same time, which is the market pricing peak earnings normalizing. A warning, not a bargain. So as we name companies, we'll read every multiple against that name's own history.
There's a deeper version of that risk worth its own minute, because it's the one we actively track. The build isn't paid for by AI customers yet, it's paid for by capital markets. Hyperscalers that used to be pure cash machines are now net spenders, issuing tens of billions in debt and equity, and money cycles between the AI labs and the very backers funding them.
End-user AI revenue, the subscriptions and the rest, doesn't yet cover the spend, so stock and bond investors are carrying the risk, not customers. That's why rising debt issuance is a signal. If the build leans ever harder on borrowed money while revenue lags, the returns question gets louder. Not flashing red today, but the gauge to watch. It helps to place this in time. Think of the AI cycle in phases. First, a broad melt-up where you just had to own the big names. Then divergence, where the market started asking who actually earns. And now a scarcity phase where the cash flows to whoever supplies the sold-out inputs.
That's exactly where the own the inputs map comes from. But there's a phase after this one, the application phase, where the durable winners finally collect cash from end users. Those leaders are still forming, and it's the one real gap in this framework. Hold that thought, we'll close on it. First, layer 1.
Silicon is layer 1 because nothing happens without it. The chips are the scarce input at the very bottom of the stack. What to watch here? Capital spending flowing into new fabs, the price of high-bandwidth memory, and the next bottleneck after memory, the optical parts that move data between chips.
And the valuation rule bites hardest here, because several of these are cyclicals. So we'll describe facts, frame valuation against each name's own history, and never call a low multiple cheap on its own. The key players, then the choke points. NVIDIA first, the franchise. Data center is now over 90% of its revenue. Gross margins run around 70%, and its real moat is software, the CUDA ecosystem that developers are locked into. It's the deepest moat in the layer, full stop.
But the risks are just as specific. It's tied to a handful of hyperscaler customers and their CapEx budgets. And those same customers are designing their own custom chips to lean on it less.
On valuation, it trades below its boom era multiple, but enormous growth is already baked into the number, so it's not automatically cheap. It's the highest quality, own the inputs name, and also the one most priced for continued growth.
Then TSMC, the toll road of the whole industry. It's the world's leading pure-play foundry. NVIDIA, Apple, AMD, Broadcom all design chips, but TSMC physically makes the advanced ones. Margins are exceptional for something this capital-intensive, and there's no true peer at the leading edge.
The defining risk is geography, the Taiwan concentration, and the tail risk that comes with it. Overseas fabs reduce but don't erase it.
Its valuation sits in the upper part of its own range. The market treats it as indispensable AI infrastructure. It's the cleanest single choke point in the layer. Less explosive than NVIDIA, but foundational to nearly everyone in this episode.
Broadcom is the custom silicon and networking play. When a hyperscaler wants its own AI chip instead of buying every GPU from NVIDIA, it often co-designs that chip with Broadcom. Add its networking and the VMware software business, and you get an enormous free cash flow machine.
Think of it as the hedge inside the layer. It wins precisely as the giants diversify away from a single supplier. The catch is concentration, a few huge customers and AI programs that can be lumpy quarter to quarter. Its multiple is a premium, not a bargain. It implies those custom silicon wins keep coming. Micron is the opposite kind of name, the highest beta input in the layer and the textbook cyclical trap. High bandwidth memory is sold out, every accelerator needs more of it, and revenue has exploded. The upside leverage is real.
But memory is a commodity cycle. A name like this can show a high trailing multiple and a low forward one at the same time, and that low forward number is not cheap. It's the market pricing memory prices normalizing from a peak.
So judge it on through-cycle earnings, not next year's. Powerful when the cycle runs hot, painful when it turns. The classic case where a low multiple equals peak earnings, not safety.
Two more silicon names round out the picture. AMD is the clearest number 2 in AI GPUs, and just as important, the bridge to the AI PC. Its chips show up in both the data center and the laptop. The catch is it's a distant second to NVIDIA, and the market already prices a lot of catch-up in.
And underneath almost everyone is ARM, the chip IP layer. It doesn't manufacture. It licenses the designs that Apple, NVIDIA, and the whole phone world build on, collecting a royalty on enormous volume. A beautiful business model. But the valuation is extreme, pricing in years of that royalty growth, so it's the opposite of a cheap stock.
Two final pieces finish the layer. First, optics, the lasers and photonics that move data between chips. As clusters grow, the interconnect becomes the next bottleneck after memory. Names like Coherent and Lumentum sit here. They're high growth and richly valued, so verify the numbers live.
Second, the semi-cap toolmakers, Applied Materials, ASML, and KLA. Every fab expansion on Earth flows through their equipment. And ASML has a genuine monopoly on the lithography machines for the leading edge. More cyclical, tied to the capex cycle. But they're the picks and shovels of the picks and shovels. That's layer 1.
Layer 2 is delivery, the clouds that turn raw silicon into AI anyone can use. The twist in our framework: these giants are the spenders, so the market judges them on returns, not just growth.
And the valuation lens shifts here. These are mostly secular businesses, so a compressed multiple usually reflects doubt about capex returns, a different signal than the cyclical peak we just saw in memory. The 5 giants, the plumbing beneath them, and the reed that ties it together.
Microsoft first. The bull case is Azure, a consumption-priced cloud that grows directly as AI workloads grow, plus the OpenAI relationship.
The bear case is twofold. A capex bill approaching $200 billion a year that the market is openly questioning, and a subtler thread. If AI agents let people get work done without ever opening Office, that threatens its seat-based productivity revenue. And watch the cascade. If Office gets used less, there's less reason to stay on Windows.
The franchise is intact and largely self-funds its capex, a relative strength in a world of debt-funded builds, but the multiple only works if that spending earns its return.
Alphabet looks like the least weak hyperscaler, and the reason is integration. It owns the model, Gemini, its own chip, the TPU, and the cloud, with a giant advertising engine funding the whole build from cash flow.
The risks are real and specific. AI answer engines could weaken the classic search ad model, and it faces serious antitrust pressure in the US and Europe.
But the multiple implies AI preserves search economics while the cloud scales. Not a bargain, but it's the strongest cash engine in the group, and the most input-integrated of the spenders. It owns the model and the chip and the cloud.
Amazon pairs the number 1 cloud, AWS, most of its profit, with its own custom Trainium chips, which gives it a slice of the input layer 2, plus a fast-growing, high-margin ads business.
The pressures are the same family. An enormous data center capex bill compressing free cash flow, and cloud competition from Azure and Google. The story hinges on AI infrastructure monetization outrunning the capex, a premier operator, but a spender nonetheless. Oracle is the interesting one, not a classic laggard. It's pivoting hard into AI cloud infrastructure, and its contracted backlog has reportedly ballooned into the hundreds of billions. That's the upside.
But it's also the poster child for the financing risk we flagged earlier. Unlike Google or Amazon, Oracle may need to fund its build-out with debt, and free cash flow has been pressured by the spend. Can it convert that giant backlog into profitable revenue without straining the balance sheet? Higher upside and higher risk than the other clouds. Apple is the odd one out. It isn't a hyperscaler spender at all. Its AI bet is on-device, tied to its own silicon, with services as the margin engine across 1 billion-plus devices. It's the largest edge AI distribution on Earth.
The risks. Heavy exposure to China for both demand and manufacturing, and a real question of whether it's lagging on AI features and interfaces. Its valuation already assumes services durability and an eventual AI-driven upgrade cycle. So it's priced for success it still has to deliver. Below the hyperscalers sits the plumbing that actually assembles the compute. The AI server makers, Dell among them, bolt the GPUs, memory, and networking into the racks. It's a high-volume, lower-margin business, so read its low multiple as the structure of the business, not a bargain.
Then the neoclouds, newer names like CoreWeave that rent out GPU capacity at scale. They're the high-torque, high-risk edge of the build-out. Fast-growing, but often the poster children for the circular financing worry, since they borrow heavily to buy the very chips they rent. Exciting, fragile, and definitely not the calm part of the chain. And there's a quieter way the infrastructure layer cashes in, the real estate. Data center REITs, names like Equinix, own the buildings and the interconnection where all this compute physically lives, renting space and power to everyone regardless of which cloud wins.
It's a landlord model on the AI build, steadier than the chips with its own constraint, which is, again, power and permits. Think of it as owning the ground the gold rush happens on, rather than betting on any single miner. So step back on layer 2. Infrastructure is where AI reaches users, but in our framework these are the spenders, and the market has been harder on them than on the suppliers, precisely because of capex return doubt.
What would flip it? Visible proof the capex is earning its return, cloud margins holding as AI scales, would re-rate the whole group. The opposite, rising debt-funded spending while end-user revenue lags, would deepen the doubt. Now the layer all of this physically runs on. Here's the shift almost no one priced a year ago. The hardest part of building AI is no longer the chips. It's finding the electricity to run them. And this is the lowest fragility input layer, because everyone needs the power and the metals no matter which model wins.
Why does it have pricing power? Because the US grid is the binding constraint. New capacity takes years, and some regions are pausing new data center hookups, while China generates about twice the power and builds it in months.
That scarcity is exactly why US-listed power suppliers can charge for it. One caution before the names. Most are commodity cyclical, so read them against the price cycle. A low forward multiple can mean peak earnings, not a bargain.
GE Vernova makes the gas turbines and grid equipment power plants and data centers need, and it's one of only about 3 companies on Earth that build heavy-duty turbines at scale. Its backlog is sold out for years, and it gets paid regardless of which AI model wins.
That's the appeal, realization agnostic, with strong cash generation. The catch is it's sharply re-rated and has a short history as a standalone company, so the valuation embeds backlog scarcity and margin expansion. Little room for execution slips. It's the highest quality, least commodity name in the layer. Cameco is uranium fuel for the nuclear restart. The clean, around-the-clock power that AI data centers love, plus a stake in reactor maker Westinghouse.
It's a secular story riding on a commodity cycle. The uranium price can dominate earnings, up or down, and its multiple already capitalizes future scarcity. The blue-chip fuel anchor of the layer, strategic and durable, but still commodity exposed.
Vistra is a large U.S. power generator with a valuable fleet of nuclear and gas plants in constrained markets like Texas, increasingly prized for round-the-clock, carbon-free power. It signed long-term deals with the likes of Meta.
But it sells power at market prices, so its earnings are cyclical. A lower forward multiple is not automatically cheap. Merchant power earnings can be peak cycle when power prices are high. It's the most direct bet on tight U.S. power markets, but more cyclical and more levered than GE Vernova. The power demand is so large it pulls in a whole subgroup. Constellation is the largest nuclear operator in the U.S. Exactly the round-the-clock, carbon-free generation hyperscalers are signing long deals for, including headline data center contracts.
It's a cleaner, AI power story than a pure merchant generator, but the same discipline applies. A lot of the good news is already priced, and it's still exposed to power price and regulatory cycles. The independent power producers are where electricity scarcity turns directly into revenue and into volatility. One layer most people miss: the electrical equipment between the grid and the chips. Companies like Eaton make the switchgear and power distribution gear every data center needs, and Vertiv makes the power and cooling systems that keep dense AI racks alive.
These are diversified picks and shovels with long backlogs, less commodity exposed than the generators, more tied to the build cadence. The thesis is simple. You can't energize a data center without this gear, so it gets paid on every build, whoever wins the cloud war. MP Materials is the most strategic name in the layer. It runs the only scaled U.S. mine-to-magnet rare earth operation, the magnets that go into motors, robots, and defense hardware. China still dominates this supply chain, which is the whole point.
It's pre-scale and currently loss-making with a heavy build-out, so there's no clean earnings multiple. This is strategic option value on U.S. rare earth independence, backed by a Defense Department deal with a price floor. The highest geopolitical convexity in the layer, most fragile operationally, most valuable if reshoring accelerates. Then Freeport-McMoRan copper. Every data center, every grid upgrade, every electric motor needs enormous amounts of it, and new supply is slow and hard to permit. It's the metal of electrification, AI included.
The catch is that copper is a global growth commodity, so it's cyclical, and it's also tied to Chinese demand, which links it to a different thesis entirely. It's the broad pick and shovel on the whole electrification wave, with commodity price risk as the trade-off. The layer read, Power and materials is the lowest fragility input. These suppliers get paid no matter which model or hyperscaler wins, because everyone needs the electricity and the metals. The honest caveat is that most are commodity cyclical, so valuation always reads against the price cycle, never as plain cheap.
And unlike silicon, there's no single clean ETF for this mix. It spans turbines, uranium, merchant power, rare earths, and copper, so it's a basket you assemble yourself. What would change the read? Power capacity finally catching up, or a commodity price reversal turning the cycle? Layer 4 is physical AI, humanoids, autonomous vehicles, factory automation. It's the eventual endgame of the whole chain, but still a watch layer.
Why watch and not own? Because the best pure plays are private, and none of our upgrade triggers have fired yet. No humanoid shipping more than 10,000 units a year, no robot line that's a real share of any maker's revenue, no true cross-domain generalization.
So the investable read is the same principle one more time. Own the inputs, not the robots. NVIDIA's robot brain stack is the de facto exposure we'd already have from Layer 1, and the one profitable robotics name worth watching is in surgical systems.
There's one more direction worth flagging: the edge. As models get more efficient, more inference runs on your own device and on AI PCS, instead of only in a giant data center.
That broadens where AI happens. It's the on-device silicon and the PC maker's angle, without changing the core thesis. Just remember the valuation discipline there too. The cheapest-looking edge names are often low-margin or cyclical, so verify the economics live before you trust any single number.
If you want the theme rather than single names, describing, not recommending, the cleanest proxy is for Layer 1, a semiconductor ETF like SMH or SWXX, cap-weighted to NVIDIA, TSMC, and Broadcom. Broader funds like XLK or QQQ blend the silicon and infrastructure layers cheaply.
But notice the gap. There's no clean single ETF for the power and materials layer, that one you assemble yourself. And the catch with any ETF is it blends winners and losers. So where one layer clearly leads, inputs over spenders, the named leaders or a tighter basket can outpace the broad fund.
Two cautions to close the ETF point. Leveraged products like a 3x semiconductor fund are tactical only, they decay over time, not something to hold. And a broad fund will always dilute the exact winners the layer map is trying to isolate. Step all the way back, and notice the pattern repeats beyond AI. Own the inputs, not the spenders, shows up everywhere. In software, the usage price supplier tends to beat the seat-based spender. In power, the equipment maker beats the operator. In AI, the chip and the electricity beat the hyperscaler.
It's the same idea each time. Value accrues to the supplier that gets paid no matter which end customer wins. That's the lens we carry across the whole framework, and the AI value chain is just its clearest, biggest example. The projection. Demand looks intact and still accelerating, and we're in the scarcity phase, where the scarce inputs get paid regardless of which model or hyperscaler wins. The honest limit is that application phase we flagged. In past tech waves, the ultimate winners were the layer that collected cash from end users, and those leaders are still forming. Inputs win the scarcity phase, applications win the monetization phase, and we don't have a clean application lens yet.
So what would change our mind? The kill criteria we watch. A genuine 5x efficiency chip breakthrough that ends the shortage. CapEx guidance finally getting cut, or the build getting ever more debt-funded while end-user revenue lags.
Until then, across all four layers, the net read is the same. The scarce inputs are where the cash sits, but they win on scarcity, not durable moats, so the moves can reverse fast. That's the thesis, top to bottom, and we keep testing it. If this was useful, the best way to support the show is simple.
Follow or subscribe and turn on notifications. You will catch each new thesis check the moment it drops.
Share it with someone who thinks in frameworks too. And we read the comments, so tell us where we are wrong.
Thanks for listening. We will keep testing the theses in public.